Hello there, and welcome to iSectors' first quarter 2025 market review video. My name is John Koch, iSectors' Chief Investment Officer, and I'm joined today by the CEO of iSectors, Vern Sumnicht. Today, we'll go through a quick rundown of how the markets are performing so far this year and how the iSectors post-MPT models have responded to this volatile environment we're currently experiencing. Okay, to kick it off, let's look at how a handful of sectors performed in the first quarter of 2025. This graph here shows returns for the 9 sectors we analyze in the post-MPT allocation universe. I'll list all 9 of them soon, but there are really only 2 that matter for now. You can see here how much better gold did than all of the other sectors and how much worse technology is doing than the other sectors. Gold up 19% in the first quarter and tech down almost 13% in the first quarter. It's just really interesting to see this trend emerge of these 2 investments separating themselves on both ends of the spectrum. And just to let you know, the sectors in the middle to round out our investment universe are financials, energy, basic materials, real estate, treasury bonds, healthcare, and utilities. So we have some of the GIC sectors along with some other asset classes like gold and treasury bonds that we analyze within the post-MPT universe. So I think the moral of the story for this chart is that hopefully everyone knows how important it is to diversify away, if possible, from the tech-heavy market cap weighted indexes that are leading the charge as far as inflows go over the past few years. Your SPYs, your VOOs, your IVVs, things like that. And so speaking of diversification, let's talk a little bit more about that on the next slide. When it comes to diversifying away from equity indexes, the first thing many people think of are bonds, naturally. After all, for years, they exhibited strong and negative correlations with stocks. The bonds would go up when stocks go down and vice versa. Unfortunately, that just hasn't been the case in recent years. Stocks and bonds are both losing money over the last 6 months, as you can see represented in the purple and orange lines in the chart on the right. AGG, which is the iShares Aggregate Bond ETF, and SPY, the Spider S&P 500 ETF, both negative over the last 6 months. Gold, I'm sure you could have guessed based on the last slide, is represented here with the ticker SGOLD, the Aberdeen Physical Gold ETF, is performing well, up 26% over the last 6 months. But another worthy diversifier so far this year in the last 6 months, like on this chart, has been Bitcoin, which I'll mention Bitcoin again later in the video. We'll touch on that again. I'm sure many of your client portfolios would have benefited from more diversification in Q1 away from those tech-heavy indexes, especially in the face of tariffs and a trade war that we're going through right now. So in response, we all know what happened. In response to the White House new tariff policy in early April, markets sold off hard. We all witnessed it. We all experienced it. They've since bounced back a little bit, but many versions of so-called soft data are still showing weakness. Consumer sentiment is dropping, along with other bearish surveys coming in and being released. The VIX spike has pulled back a bit, but the VIX is still heightened. This has all led to the fear and greed index still tilting hard towards fear, even after the recent rebound over the last few weeks and the overall strength of the stock market over the last few years. Now, on the flip side, hard data, actual economic reported data, has not shown the same weakness. Yet, at least. For example, on this chart, credit spreads did rise. You can see the low in January 2025. They did rise and have come back a little bit, but they're still right around their historic averages. Also, the same can be said for unemployment. Unemployment is stable and it remains low. It ticked up recently, but all in all, compared to historical norms, it's right in line. Even the weekly job data, the payroll data hasn't really shown many cracks either, as we've gone through this rocky month of April so far. We at iSectors, we prefer the hard data. Surveys and sentiment readings, they tend to be descriptive statistics, not predictive statistics. Sentiment is low because the market just experienced a 10% drop in the matter of days. That low sentiment, it describes what just happened in the market, it doesn't necessarily describe what is going to happen in the future of the market. Some of these hard data points I've shown, credit spreads, unemployment, we also use CPI, GDP growth is another good one. They've shown that they can be predictive statistics, that they actually have an influence on stock market returns in the future. So that's why the algorithm that powers the iSectors post-MPT allocations, we use hard economic data points and capital market factors like unemployment, and credit spreads, like I mentioned. And as a matter of fact, the reliance on hard data that our models have had, the post-MPT model specifically, it's led to some solid performance in recent periods. You can see here, both the iSectors post-MPT growth and post-MPT moderate allocations have beat their benchmarks year to date and over the last 12 months. Year to date, both growth and moderate are up, while their respective benchmarks are down. The S&P 500 and a 60/40 stock bond index. This tends to be what happens too. Both these models tend to perform very well when their benchmarks are negative in a given period, which is that's what we've seen so far this year. And so on the next slide, I'll get into what has powered these returns so far this year, but we've seen it twice already. You know, the first slide and the second slide, I'm sure you could guess what has helped propel the post-MPT models to this positive performance so far this year. It has been their heavy allocation in gold. Right now, post-MPT growth has about a 37% allocation, and post-MPT moderate right about 28%. Both of these models, after the model changes that we employed at the end of last month, these models trade monthly, and we run our algorithm monthly. They both still hold this heavy allocation to gold bullion, which that's been the case for almost 2 years now. We switched the gold position within these models from gold miners to gold bullion in April of 2023. And both models have essentially held the near max position within gold since then. But now, so for some other changes, growth has started to deviate further away from moderate's allocation, besides the gold, of course. It sold some technology last quarter and bought energy stocks, bringing energy up now actually to an equal weight with gold in the model. They're both about 37%. Post-MPT growth really is leaning much more into the inflation side of stagflation. The models have both been positioned for stagflation. We've been talking about it basically since April 2023. The last couple of years, we've been talking about stagflation quite a bit. But it does seem that growth is really leaning more into the inflation side of stagflation, whereas moderate, on the other hand, it still has a high tech allocation. It has bond exposure and a much lower energy allocation than post-MPT growth does. It's positioned, basically, moderate is positioned more for the slow growth side of stagflation as opposed to the inflation side of stagflation. You know, it does still have the gold, but it's not going heavy into gold and energy like growth is. One other thing I'll point out on this chart as well before we go, you might have noticed that both models now have a 5% Bitcoin allocation that we added last month. This quarter, we actually made a decision firm-wide to add Bitcoin to all iSectors models with equity exposure based on our firm-wide conviction in Bitcoin. It's not going to affect the other 95% of the post-MPT models with their dynamic allocation strategy month to month, but it is a 5% siloed allocation in both models. You can read more about that in the link in the description below. We're going to post a link to an article that we wrote, you know, basically stating our case for Bitcoin and why we think it belongs in our allocation models. I think then that's it. That's all we have for today. Vern, I don't know if you want to add anything. Here's our contact information.
John, you did a great job, other than the fact that you want to say we're available. If anybody has any questions, we will make all of, we are all available. John's available. You can see his contact information there. Welcome to contact Scott Jones. And if you'd like to talk to me, I'd be more than happy to make myself available as well to any of the advisors out there. Then, and we hope that the Bitcoin allocation will help our advisors to talk about, give you something very, I think, interesting. A lot of your clients are going to be very interested in having an allocation to Bitcoin. And the article that John talked about that he's linking below will give you a number of talking points. We hope to discuss this with some of your clients. Otherwise, thank you very much, John. Appreciate it. It was a good presentation.